Yes, hello, good morning at this unusual time for our course, but I will participate at a Bundesbank conference on cash this afternoon in Frankfurt, and so we have to do it a little bit earlier today. And for those who aren't able to attend, of course, everything is recorded, and so I hope this will not create a major problem. Okay, where do we stand? So last week we talked about the ECB and the mandate of the ECB, the targets of the ECB. And the question is now, how can the ECB reach these targets? What are the instruments for the ECB? And of course, here we are. The main instrument for monetary policy are the interest rates. This can be derived from our very simple macroeconomic model, where we assume that the central bank can target the key interest rate that is relevant for spending decisions. And the question is now, how can a central bank target interest rates? And here it's also important in this context, of course, when we talk about interest rate in the Keynesian model, it's always a monetary phenomenon, the interest rate. It's the price for money tomorrow relative to 1 unit of money today. And what is also important when we talk about the real interest rate in this context, it is not the commodity interest rate of the classical model, it is the monetary interest rate of the Keynesian model deflated by some kind of price index. Okay, yes, and we have seen in our model that interest rates are the main transmitter of monetary policy into the real sphere. I think this is also something very relevant in the Keynesian model, that the central bank can influence the real sphere directly, something which is not possible in the classical model. And so the whole importance of the central bank in macroeconomic policy derives from its control over interest rates. And the question is now, which interest rates can and should the central bank target? And here we see two different approaches. One is what is called conventional monetary policy. And conventional monetary policy is what central banks mainly did until the financial crisis in 2009. And conventional monetary policy means that the central bank targets a very short-term interest rate, and it's normally the interest rate on the so-called money market. And the money market is the market with banks, commercial banks as main participants, and the object that is traded on this money market are central bank reserves, deposits of the commercial banks with the central bank, and the money market is the place where commercial banks trade central bank reserves. And we'll talk about this in more detail. And what is important for conventional monetary policy is that it focuses on the control of the money market rate, and it hopes and believes and knows that there is some connection between the short-term rate and the long-term rate. Because obviously this money market rate, which is of a very short maturity, most of it is just overnight maturity, is not that relevant for longer-term investment decisions. And so, of course, if central banks target the money market rate, there must be an impact of this very short-term rate on longer-term rates and also interest rates, not only for loans to banks, but mainly interest rates for loans to firms or for mortgages. So it is important in conventional monetary policy that there is an impact and there's somehow reliable relationship between this very short-term rate that the central banks are targeting and the longer-term rates for bank loans to firms and to households, especially for mortgages. So this is the philosophy a little bit of conventional monetary policy, that we have this focus on the short-term rate, but the idea is that the short-term rates have an impact on longer-term rates, and among the longer-term rates, of course, also the interest rates on the capital markets, the interest rate for bonds, for government bonds, for corporate bonds. So this is conventional monetary policy. This is more or less the philosophy of interest rate policy until the financial market crisis, financial crisis in 2009. Since then, the situation has changed, and we have now, in addition to conventional monetary policy, also something which is called unconventional monetary policy. If it's called unconventional, maybe this is no longer the right term for this, because it has become conventional now in the last decade, and especially in the COVID pandemic. And unconventional means that the central bank targets short-term rates, but also long-term rates. And the idea is that the central bank targets long-term rates directly by purchasing or selling government bonds and corporate bonds. And there are also ways to target long-term rates in an indirect way. One is the policy of forward guidance, where central banks make announcements on the path of short-term rates with the hope that this announcement has an impact on longer-term rates. And the second way to target long-term rates indirectly are the so-called long-term refinancing operations by the ECB. And these are longer-term loans from the central bank to banks with a maturity of 3 to 4 years, which give banks the money to purchase government bonds for a 3 to 4 year period. And then via this indirect channel, the central bank can also exert some impact on the longer term rates. So we have conventional monetary policy, which is really what you could observe until 2008 to 2009. And then since then, we have this unconventional monetary policy where the short-term interest rate control is augmented by direct control over the long-term rates or indirect control over long-term rates. So when we talk about the targeting of interest rates, we can go back to John Maynard Keynes, and he was someone who was very familiar with financial markets, with money market rates, because he did a lot of speculation on financial markets. Sometimes he was successful, sometimes he lost a lot of money. I think 2 times he lost almost all the money that he owned. I think also money of friends, but in the last moment he could shift the situation, and so overall I think he was relatively profitable. But he's really someone who was very familiar with financial markets. And what I just presented you, these 2 different ways for central banks to target interest rates, is something that he described already in the 1930s in his treatise on money. And he says, first, there is no doubt, no reason to doubt the ability of a central bank to make its short-term rate of interest effective in the market. Yes, central banks control short-term interest rates, and then this is the interest rate that is really relevant in the money market rates. And then the second aspect, the idea that the short-term interest rates have an impact on longer-term interest rates. And here he says short-term rates influence long-term rates more than the reader might expect. It's not difficult to find sufficient explanation for this observed fact. And then he already talked about unconventional monetary policy, saying it should not be beyond the power of a central bank, international complications apart, to bring down the long-term market rate of interest to any figure at which itself is prepared to buy long-term securities. I think this is a wonderful explanation of unconventional monetary policy, where the central bank, by purchasing or selling long-term security, is able to control the long-term interest rate on the capital market. And then what is very nice, it says a complex offer by the central bank to buy and sell at stated prices gilt-edged bonds of all maturities in place of a single bank rate for short-term bills is the most important practical improvement which can be made in the technique of monetary management. And this was in his general theory. And we will see at the end of this lecture that this idea of Keynes, that the central bank should control the interest rate for different maturities, is exactly what the Bank of Japan has developed in the 2010s with a policy that the Bank of Japan calls yield curve control. Okay, so you can see these ideas were already there many years ago by Dominic Keynes, and today we can really see how these different dimensions of interest rate targeting are now practiced by central banks, and especially by the ECB. So, conventional monetary policy means the central bank targets short-term interest rate, and the field of action of conventional monetary policy is a so-called money market, and that's the market where banks trade central bank reserves. And this raises the question: why do a commercial bank need central bank reserves? We've already seen that whenever a customer makes a payment from bank A to bank B, then the reserves of bank A are reduced. So in order to make payments for its customers, commercial banks always need a certain amount of reserves with the central bank. And the second reason why commercial banks need reserves is that banks have to hold minimum reserves. In the case of the ECB, it's 1% of short-term deposits. So if you have now the system of commercial banks, and you can now imagine that payments transactions are taking place from one bank to another, and this goes back and forth during the day and also during the week, then there will always some banks who have more central bank reserves than they need for payments transactions and the minimum reserves, and there are other commercial banks who have less reserves than they think are required for their payments transactions and for minimum reserves. So due to these payment processes, which have their own dynamics, there are always some banks with too many reserves and always some banks with too little reserves. And now the money market is now the place where banks who have not enough reserves, in their view, can borrow reserves from commercial banks who have too many reserves. And so the money market is a kind of system of communicating tubes. Some banks have too many reserves, some banks have too little reserves, and by trading these reserves on the money market, you can reach a situation where all banks have a sufficient amount of reserves. Therefore, the money market is a very important element in the financial system. Of course, when banks lend money to each other, there's always a risk that a bank becomes insolvent, and therefore most of the trading in the money market is now only against collaterals, so that you can be sure that if you lend to another bank, that there is some collateral in case this bank becomes insolvent or liquid. So this is the role of the money market, and the maturities in the money market range from overnight, so just for one day, up to about 12 months. And in normal times, it's really a very efficient system, like a system of communicating tubes. It's obvious when you have a financial crisis, when the health of some banks is at stake, you get problems in this money market, and then the communicating tubes do not work as required. So on this money market, we have different interest rates. In the euro area, the interest rate for overnight lending, very short-term lending between commercial banks, is so-called EONIA. EONIA means Euro Overnight Index Average. And then for the longer maturities, we have Euribor, Euro Interbank Offered Rate, for maturities from 1 week up to 12 months. So this interest rate on the money market is the rate that the ECB is targeting with its conventional monetary policy. In the United States, the money market rate that is relevant for the Federal Reserve, federal funds rate. So again, the rate that the Federal Reserve is targeting is the federal funds rate. And the federal funds rate is also an overnight rate for commercial banks. Okay, so how can you target this money market rate? How can you do it as a central bank? There are two different ways to do it. One element of the ECB's instruments to target the money market rate is what is sometimes called a corridor system, which sets a upper and lower limit for the money market rate for this overnight rate. This corridor system has two facilities, each one setting upper and the other setting a lower limit for the money market rate. One facility, which is relatively important, is so-called deposit facility, which is a lower bound for the money market. Deposit facility means if a bank has more reserves than it needs, it can always transfer these reserves to the deposit facility of the central bank. And as the deposit facility is remunerated, so you get an interest rate for it, the rate for this deposit facility is the lower bound for the money market rate, because if I can lend to the ECB at a rate, let's say, of 1%, I will not lend to a commercial bank at a rate that is below 1%. So the deposit facility sets a lower bound for the money market rate. And a facility means it's always the decision of the banks how much money they want to deposit at this facility, so there's no quantitative limit. And facility also means that the banks, the money in this deposit facility is highly liquid, so the banks can withdraw the money from the deposit facility at their own discretion at any time. So it's really a very short-term facility, and therefore the deposit facility is effective lower bound for the ODR rate, for the overnight rate on the money market. The other element of the corridor system is the marginal lending facility with the marginal lending rate. And the idea is now banks can borrow reserves from the ECB overnight at this marginal lending rate. And the logic again is the same. So if banks can borrow from the ECB, let's say at 2% at the marginal lending facility, there's no need to borrow from another commercial bank at a higher rate. So the marginal lending facility sets an effective upper bound for the money market rate. And again, it's also an overnight facility. So banks can borrow just for one night, and they can always repay if they have borrowed money from the lending facility, they can repay it at their discretion at any time. So one would say, well, this is nice and symmetric, but in reality, the marginal lending facility does not play a major role. It has a kind of stigmatizing effect. So if a bank needs money from the marginal lending facility, there must be a lot of transparency in the communication among banks, and this means you're really broke when you have to go to the marginal lending facility. So the marginal lending facility does not play an important role in practical monetary policy. As this is the case, there must be other instruments where the banks can get reserves from the central bank, and here we come to the so-called main refinancing operations, and these are de facto short-term loans to banks. With some years it was a 2 weeks maturity, but now most of the time it was 1 week maturity. And at this main refinancing operations, banks can borrow reserves from the ECB for 1 week, and the difference to the facilities is that the ECB decides how much money the banks will get from these operations. And in the past, it was sometimes a kind of bidding process. So the banks told the ECB how much reserves they wanted to borrow, and then the ECB decided kind of allotment process how much what percentage of the bids was supplied by the ECB. Since the financial crisis, there are no quantitative limits on the main refinancing operations. So here we can, excuse me, here we can see this system in operation, and we have two different periods: the period before the financial crisis and the period after the financial crisis. And we can see in the period before the financial crisis, we can nicely see these corridors, the marginal lending facility, the deposit facility, and we can see the blue line, the EONIA, fluctuating a little bit, but more or less in line with the yellow line, which is the main refinancing operations. And this, you can see that with this system, a perfect control of the EONIA was not possible. So EONIA was sometimes higher, sometimes lower. And this is due to the fact that this main refinancing operation has a 7 days maturity. Sometimes they have a 14 days maturity. And of course, if you have very short-term fluctuations on the money market, short-term liquidity needs or short-term liquidity shocks, which have the effect there's too much liquidity in the market, then the EONIA has to react and it's going up or down. And you can see, especially in the beginning, we had lots of fluctuations. And yeah, this is simply due to the fact if you want to stabilize an overnight interest rate with a 7-day or 14-day main refinancing operation, this is not a perfect control. And so you can see these fluctuations. But overall, you can see that EONIA was more or less in the center of this corridor, and one can say, well, if you have these short-term fluctuations of EONIA, it's also not a major problem. So it's probably not nice, but you can also see that more or less the control became more perfect, and it's huge, these relatively strong variations of EONIA was mainly a problem in the first years of the ECB's operations, where also the ECB had to gain some experience of how to do it. But overall, that's how the system worked. And now we can see after the financial crisis, the situation became very different. Especially if you go to this part here, you can see that EONIA had no longer any contact with the main refinancing operation, and that the deposit facility became not effective for controlling the money market rate. And this shift is mainly due to the fact that after the financial crisis, there were huge purchases of government bonds in the form of the unconventional policy, which created excess reserves. And these excess reserves had the effect that the banks always had more, the whole system had more reserves than required. And with the deposit facility, the ECB prevented the money market rate to go even more negative. And so the deposit rate became the effective rate. And one can say, while before the financial market crisis, the rate for the main refinancing operations was the policy rate, the rate with which the central bank effectively targeted the money market rate, it has shifted. And now the rate for the deposit facility is now the effective rate for the control of the money market rate. And you can say the rate for the deposit facility has become the policy rate of the ECB. So this shift in the money market control of the ECB is also reflected by the importance of the instruments. Here, in the situation before the financial market crisis, you can see that the main refinancing operation was really the main refinancing operations. So the refinancing operation accounted for about 80% of the supply of reserves by the ECB. The ECB also had some kind of longer-term refinancing operations in the period before the crisis, but they did not play a major role. And what you can see here is that the main refinancing operation more or less vanished. It's still called the main refinancing operation, but it has become almost irrelevant. And now, especially since with COVID, but already before, the security operations account for most of the supply of reserves by the ECB. But we also had a period, and I'll explain this also in more detail, in the years 2010, 2014, where you see this orange shaded area, and these are the longer term refinancing operations. And they also were very important for the ECB's targeting of interest rates, especially for targeting the longer term rates, but I will explain this shortly. But so you can see here this important shift until the financial market, until the financial crisis, that supply of reserves mainly by the main refinancing operation. And now it has shifted in the period, let's say 2010, 2015, 14. The longer term refinancing operations were the most important instrument. And since then, the bulk of the supply of reserve comes from the purchase of securities by the ECB. So it's quite interesting, I think, to see this shift in the operations, and this shift in the importance of the instruments reflects also the shift from conventional monetary policy, which mainly targets short-term rates, to unconventional monetary policy, where the targeting of longer-term interest rates plays a decisive role. Yeah, I think maybe the chart here on the left is not that relevant. It's in absolute terms, but here you see the importance of the instruments in relative terms. And this shift is also nicely reflected by the use of the facilities. You can see until 2008, neither the margin lending facility nor the deposit facility reached any significant amount, was almost unimportant. And we have seen it here quite nicely that in this period, the money market rate never reached the upper or the lower bound set by the deposit rate or the marginal lending facility rate. And so you can see until 2008 here, both facilities were more or less irrelevant for the interest rate policy of the ECB. But then the deposit facility gained in importance quite significantly. And we have seen this already. And here, the margin lending facility, you can see here, you might need a microscope. Only in very, very turbulent times, there were some banks who obviously were forced to go to the marginal lending facility. But here, this is 2008, autumn 2008. This is really at the most serious time of the financial crisis. Some banks were forced to do it, but even at that time, you always need a microscope to see the effects, to see that the marginal lending facility was used by banks. Okay, so this is in a very, very rough way the presentation of the ECB's conventional monetary policy, and you already have now seen the shift that has taken place, but we will discuss this in more detail. And as I said, in the conventional monetary policy, the idea was always that when you target short-term rates, you always have some impact on longer-term rates. Here on this chart, you can see the short-term and long-term interest rates for Germany and the United States. The short-term rate is this money market rate, the overnight money market rate, federal funds rate for the United States. And here the money market rate reported in Frankfurt. And the long-term rate is a rate for long-term securities. In the case of the United States, it's 10-year treasuries. In Germany, it's a kind of average yield for domestic debt securities. And you can see overall that there is a kind of relationship between long-term and short-term rates. But of course, it's not 100%. There are deviations between the short-term rate and the long-term rate. So when you target short-term rates, of course you have an effect on long-term rates, but it's not perfect, and this is mainly due to the fact, and you talk about this soon, is that the long-term rates always reflect the expectation of future short-term rates. And when you have here a decline, let's say here in the federal funds rates, it's not clear for the market participants whether this will be permanent or whether it will be only a short-term situation, and therefore the adjustment of the long-term rates to a decline in short-term rates is relatively sluggish because for long-term rates the expectations about future short-term rates matters, and that's something that the market participants do not know, and therefore this kind of sluggish adjustment of long-term rates to short-term rates. But you can see overall there is a relation there. I think in the United States it's probably even more pronounced than in Germany. But so that was the philosophy of the conventional monetary policy, and the relationship between short-term and long-term rates goes back to the expectation theory of interest rates, or of the interest rate structure. Theory goes back to Irving Fisher, and the idea is that long-term interest rates are determined by the current short-term interest rate and expected future short-term interest rates. So long-term interest rates are determined by the expected development of short-term interest rates. And I think that's quite logical. Imagine you have 1 million euros and you want to invest this 1 million euros for a period of 10 years. And then you have two different options. One is you buy a long-term 10-year bond. And then you have the money invested for 10 years. And the idea of this expectation theory is now, instead of buying the 10-year bond, you buy a 1-year bond for 1 year, and next year you buy another 1-year bond, and so on. So instead of investing in the 10-year bond, you can invest in a series of 1-year bonds. And the idea is now that if you ask yourself, what rate do I want for my 10-year investment, then of course the idea is the return for the 10-year investment should be the same as a return of the series of 1-year investments. And so you can ask yourself, what is my expectation for the 1-year rate for the next 12 months? What is then the expectation for the next investment of the 1-year rate, and so on and so on. And so the idea is that in equilibrium, the 10-year rate reflects the expectation of the market participants about the sequence of 1-year rates. And that's the idea of this expectation theory. So when people ask themselves, what is adequate rate for 10 years, they ask themselves too, what do I expect about the 1-year rates for this 10-year period? And the assumption of this expectation theories is that bonds with different maturities are perfect substitutes, which they are to some degree. You can buy a 10-year bond, and you can also, and if you have 1 year bonds, then they are more or less perfect substitute. So the idea is, given this expectations theory, with conventional monetary policy, of course, the central bank, you only set the short-term rate, but you can also do something to influence the expectations on short-term interest rates over 1 year, 2 years, or 3 years. And this is an instrument that has become quite attractive for central banks. It's already an instrument, one can say, of unconventional policy. It's the so-called forward guidance. By forward guidance, central bankers make announcements on their intentions about the course of short-term interest rates, let's say for the next 12 or 24 months. And with this, of course, you can then have an influence via the expectation theory also on longer-term interest rates.
Just one question.
Yes.
With respect to short-term and long-term rates, what does it mean if the short-term rate is above the long-term rate? Can we interpret this in any way?
Yes, we can do that. So if the short-term rate is above the long-term rate, here, that's a very good question. What does it mean if the short-term rate is above the long-term rate? What would you think? Somebody answer? Maybe a short explanation. So the spike of the short-term rates in the United States was in 1981, when inflation was relatively high. In the United States, the central bank president was Paul Volcker, and he really tried to get inflation down in a kind of brutal way. He always also tried some kind of monetary target monetary base on a weekly basis, and this led to excessive interest rates from today's perspective. So these are the monthly average of the federal funds rate. I think it was on a daily basis, the federal funds rate even exceeded 20%. And so, yeah, what are, I think that's a nice way to apply these expectations here of interest rates. Why did the short-term rate not make the same jump, so to say, as the short-term rate? What is the idea? What were people expecting? Because long-term rate is always about expectations. Well, the idea was of market participants, well, now we have the 20%, they have a 20% interest rate. But the orange line is the long-term rate for 10 years. And so market participants thought, I assume, well, today the short-term interest rate is really high because we have this inflation, but once inflation is under control, the short-term rate will not remain at this excessive level. So the short-term rate will come down, and especially over a 10-year period. And so I think the lower longer-term rate compared to the short-term rate is exactly reflecting this expectation. Yes, this is excessive today, but for 10 years, it's absolutely unrealistic that in the United States, an interest rate of 18% would prevail. Even the 14% relatively excessive, so because it then implied that market participants expected for the next 10 years an average short-term rate of 40%. It was also a little bit high. But anyhow, you can see that when the short-term rates exceed long-term rates, especially these are periods where monetary policy is very restrictive, and then the expectation of market participants is, yes, this will have a strong impact on equity demand. We will see a recession. With the recession, inflation comes down, and with lower inflation, also interest rates come down. No, but that's a very nice question from you, because it's a nice application of this expectations theory. So, and as an example of forward guidance, there's a quote from Mario Draghi at the ECB press conference on July 26, 2018, and he said, based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Now comes the announcement. We continue to expect them to remain at their present levels at least through the summer of 2019. So he makes an announcement to keep the short-term rate stable for 1 year. And of course, this already has an effect on expectations. So you already know the short-term rate for the next 12 months. And as central banks normally do not make huge changes in short-term rates, you can also make a relatively safe expectation that after the summer 2019, the short-term rate maybe will be 1%, but not 2%. And so with this kind of forward guidance, central banks try to shape interest rate expectations. And of course, via this expectation theory, then we also have an impact on the longer term interest rates. Okay, so this was conventional monetary policy. Then we make a 5 minutes break and then we continue with unconventional policy. Yeah, then we go to unconventional monetary policy. As I said, conventional monetary policy was the way to target interest rates, more or less, I would say, until the financial crisis in 2008. And the question is, why do we need unconventional monetary policy? Unconventional policy meaning that central banks target long-term rates directly or indirectly, but not via short-term rates. And there are different motivations. We have already seen that the connection between short-term rates and long-term rates is not too direct, that it can be changing. And so if you reduce short-term rates, sometimes the reduction in long-term rates is very, very slow. And so one motivation for directly targeting long-term rates is if you have a period where you see that long-term rates remain higher than required from the viewpoint of the central bank. And so we have already in the 1960s and 1970s, the Deutsche Bundesbank had been buying major amounts of government bonds to bring long-term rates down faster than without these operations. I mentioned this because when the ECB announced purchases of government bonds in 2014, 2015, there was a lot of criticism coming from Germany that this is not the right way to conduct monetary policy, and most Germans didn't know that the Deutsche Bundesbank, which in Germany is also kind of holy grail of monetary policy, that the Bundesbank had already been practicing these kind of operations in the 1960s and 1970s. A second motivation, which has now become very relevant after the financial crisis, is that the short-term interest rate has reached the so-called zero lower bound, and that long-term rates still were higher than adequate in the view of central banks. And so if you have this kind of indirect connection between the short-term and the long-term rates, so we can, by reducing the short-term rates, you can try to get long-term rates down, but soon as you reach the lower bound, and then you can have long-term rates at levels which are deemed too high. And then, of course, the idea is, how can we get the long-term rate down once we have reached the zero lower bound? And of course, in this situation, central bank can now try to target long-term rates by purchasing government bonds. And if you purchase government bonds, of course, the direct effect is their price goes up and the yield comes down. Third motivation, which is somehow related to the zero lower bound, but entirely, that's all the logic of the modern monetary theory. We talked about this. We mentioned that according to Lerner, to functional finance, governments have a responsibility also for the price level, and especially in a situation where an economy is affected with serious negative demand shocks, governments must respond, and by higher with higher government expenditures or lower taxes. And the idea of modern monetary theory is if governments have this responsibility to stabilize aggregate demand to prevent the major disequilibrium between aggregate demand and aggregate supply, they need the support by the central bank, and by purchasing government bonds, central banks make it possible for the government to reach this stabilization of aggregate demand, to prevent deflation, to prevent unemployment without any financial constraints. I think that's a little bit the logic of modern monetary theory. Modern monetary theory assumes or suggests that the central banks directly finance the government. This is in the euro area not possible, but there are also indirect ways to finance the government. So if the government issues bonds, if the bonds are purchased first by banks on the primary market, then the central bank can purchase these bonds on the secondary market. And in essence, it doesn't make a major difference as far as the impact on the economy is regarded, whether the central bank directly finances the government or whether the central bank purchases government bonds that were issued by the government and then first purchased by banks. So this is the idea of modern monetary theory. And now if we have this COVID pandemic, I think this was a situation where we had really huge purchases of government bonds by central banks, and you can see that you can see the amount of government bonds and private corporate bonds purchased by important central banks since the end of 2019. This is a relatively recent chart by the OECD Outlook May 21, and these are really sizable amounts. So we can see almost all countries, the asset purchases of the central banks reached double-digit figures, especially in the Anglo-Saxon countries, New Zealand, UK, United States, Canada, Japan, but also in the euro area. So this is really something unprecedented, that the central banks were purchasing such huge amounts of government bonds. But I think it was really required because COVID was a very strong negative shock for all economies. And in order to stabilize these economies, it was necessary that the governments made huge transfers to private households, to firms, and also reduced taxes. And there was a lot of money was required. And without the support of central banks, the governments would have been forced to raise this money on the capital markets. And in my view, this would have led to strong increase of the long-term interest rates. And so the central banks have supported the governments in their fight against the economic consequences of COVID, and they've done it really with substantial amounts. And so this is something, really, really unprecedented. And you can see that now the amount of government holdings the central bank holdings of government securities are very high now in many countries, especially in Japan, where the central bank is holding a huge amount of government bonds. So this is unconventional monetary policy practice, and the COVID pandemic is really a situation where you can very nicely see how central banks did what they can, in the famous words of Mario Draghi, whatever it takes. They did whatever it takes to purchase government bonds and to help governments to stabilize the economy in this terrible pandemic. And one can say, yes, this was the right way to do so far, because the we have seen a strong decline of GDP in all economies in 2020, but now we also see a strong rebound in economic activity also in all major economies. And so with this approach, a Great Depression, as we observed it in the early 1930s, where we had a decline of GDP for many years, where we had serious deflation, this could be avoided. And so overall, I think it was the right approach. So the idea of unconventional policy is this directly targeting of long-term interest rates. And I already mentioned this in the case of the euro area. Purchasing of government bonds is not so easy because the founding fathers, the architects of the Maastricht Treaty, were afraid that the ECB would finance governments, and by financing governments, this would create inflation. And therefore, in the Maastricht Treaty, we have this Article 123, which prohibits the direct financing of member states by the ECB. But there was a loophole, there is a loophole, as the treaty says, or as the treaty only prohibits the direct purchase of bonds, government bonds, by the European Central Bank, and prohibiting the direct purchase of government bonds means that indirect purchases are allowed. I think that's the way out from this article, and that's exactly why the ECB is allowed to purchase government bonds. There's always some discussion by the German Constitutional Court whether it's legal or not, but so far the Constitutional Court has now agreed that the ECB is allowed to purchase government bonds. I think but the only thing where there are some limitations for the ECB is if it purchases government bonds only from one country for a prolonged period of time, then of course it would come close to a kind of direct government financing, which the treaty tries to prohibit. So we can see this very nicely now, the application. So as I said, unconventional policies are required if the central bank reaches the zero lower bound and if long-term rates are still too high. And when Mario Draghi came into office by the end of 2011, the short-term interest rate, EONIA, was more or less at the zero lower bound, but you still had relatively high long-term rates in the euro area. So this rate is a euro benchmark rate for 10-year government bonds. So it's a kind of average of government bond rates in the euro area. You can see here that especially in the years 2010, 2011, this long-term rate was very high. This was the time of the euro crisis. And you can imagine we had the Great Recession due to the financial crisis in 2008, 2009. And immediately after this recession, long-term rates went up in the euro area because there was a lot of speculation whether the euro area could be maintained or whether some countries would have to leave the euro area. It's a so-called euro crisis, and we will discuss this in a special lecture. But you can see how disastrous it must have been for the euro area that long-term rates went up to such high levels in a situation where the euro area economy was still weak. There was a lot of fiscal consolidation. There were the consequences of the Great Recession, and in that time, long-term rates went up. That was a real disaster. And so when Draghi came into office, he had reached this lower bound, and then interest rates were still high. And then he made announcements already in 2014 that the ECB intends to purchase government bonds. And you can see that already by these announcements, the long-term rates came down. As we said, the long-term rate has a lot to do with expectations. And we can see it here. So I think that's obviously I would say the worst fall. We had this great recession, the financial crisis, and the ECB was doing practically nothing in terms of unconventional monetary policy. We'll see later that in this period already the Federal Reserve, the Bank of England had been purchasing huge amounts of government bonds to keep long-term rates low or to reduce long-term rates, which is something that in this severe recession of 2009 was really needed. ECB remained absolutely passive, and that, of course, was the main problem. And you can see that ECB only started in 2015 to purchase major amount of government bonds. This was really Draghi's idea that unconventional monetary policies are needed to get the long-term rate down. And this is what happened more or less until the COVID pandemic. So with these huge purchases of government bonds and also some corporate bonds, the ECB was able to reduce long-term rates to very, very low levels. So that was, so to say, a situation for Draghi. The CLO bond was reached, long-term rates relatively high. How to get them down? You must purchase government bonds. And as I said, when the central bank purchases government bonds, their price go up. And if for a bond the price goes up, it means that the return, the yield goes down. That's a very simple relationship. So the ECB had a lot of programs to purchase bonds. And the whole program was called Asset Purchase Program, and it consisted of 4 elements: corporate sector purchase program, public sector purchase program, asset-backed securities purchase program, and the covered bond purchase program. I think you do not need to know this by heart. You can see here from the chart, the blue is the public sector purchase program. So most of the purchases that the ECB made were government bonds. And I think the second important element is the corporate sector purchase program, the yellow ones, where the ECB purchased corporate bonds. This is not it's not so clear whether this is really a good idea, because if the ECB purchases corporate bonds, of course, then it becomes a competitor with commercial banks, because the commercial banks are also lending to corporates. And so it interferes somehow with the business of commercial banks. But anyhow, the ECB decided to purchase corporate bonds. And of course, these corporate bonds, we talked about it last week, then they open also a window for the question, how green must or can the ECB's monetary policy be? So the question is, must or can the ECB discriminate among companies that are brown or green? And should it stop purchasing bonds by brown companies? And we discussed this already last week, so that at least ECB should become neutral in its purchases of corporate bonds. But by going into this terrain, of course, then all these problems arise. And I personally, I'm not sure whether it was really needed for the ECB to purchase this corporate bonds. Okay, so these are the main elements of the ECB's asset purchase program. The ECB also purchased covered bonds, and these are bonds issued by banks which are covered by government bonds. Germany is so-called Pfandbriefe. This also played some role in the beginning. But anyhow, the main elements are of course, most important is the public sector purchase program, and then in the second rank, you have this corporate sector purchase program. And so when the pandemic started, the ECB decided we need more government more purchases of bonds. And then the ECB announced the Pandemic Emergency Purchase Program. And so this program has a huge volume. It's almost 2 trillion euro, and the purchases have a maturity from 70 days up to 31 years. And what is interesting with this PEP program is that the ECB said the allocation across jurisdictions will be made according to the Eurosystem capital key of the national central banks, but purchases will be conducted in a flexible manner. What does this mean? So normally the ECB tries to have a bond portfolio which more or less reflects the capital keys of the member central banks in the ECB's capital. So the idea is not to privilege some country by purchasing a larger share of the bonds issued by some country. But here, with the PEP program, the ECB said, okay, purchases will be conducted in a flexible manner. Flexible manner means that sometimes the ECB can purchase a more than proportionate share of the bonds from one country, but of course, over time, this has to be reduced. And of course, this gives the ECB flexibility. For instance, if Italy is under pressure, at least in the short term, to purchase a relatively large share of Italian bonds, but of course, it has then to reduce it, because otherwise the ECB gets problems with the German Constitutional Court, who is very critical and skeptical about all these purchase programs. So then there's another instrument that has played an important role, especially before the direct bond purchases of the ECB. These are the targeted long-term refinancing operations, and targeted long-term refinancing operations means that the ECB is lending to banks relatively large amounts of money for a period of 3 years at a very low interest rate. And the interest rate also depends on the increase in bank loans to the private sector. So the more loans commercial bank is giving to the private sector, the lower the interest rate in these TLTROs. That's why it's called targeted. The mechanics are relatively complex, but the idea is kind of so if you lend a lot to the private sector, you get also very low interest rates from the ECB. These targeted long-term refinancing operations, in my view, are also an element in the toolbox of unconventional monetary policies, because if banks can lend from the ECB for a 3-year period at a very low favorable interest rate, one thing you can do is you use the money and buy government bonds for this period, because normally government bond yields are higher. And so this instrument enabled banks to purchase government bonds. And so the instrument can be regarded as kind of indirect bond purchase program by the ECB. And in this regard, it played an important role, especially before the year 2015, before the ECB directly purchased government bonds. And we can see that here. So the long-term refinancing operations were increased considerably by the end of 2011. This was exactly when Draghi started as ECB president. So his first decisions were this very high long-term refinancing operations. They were called Dicke Bertha, which was kind of cannon used in the First World War. And so the banks were provided ample liquidity with these long-term refinancing operations. And you can see here in this period that the bond holdings of banks in the euro area, here and here, increased considerably. And so this was a kind of indirect way to incentivize banks to purchase government bonds. And by this, way to get government bond rates down. And a similar thing happened now with COVID, where again the banks received extremely high liquidity provisions by long-term refinance operations, and again, at least a part of it was then used for the purchase of government bonds in the COVID period. So LTROs, as the ECB would say, we use them to encourage banks to lend to the private sector. This may be the case, but it's a very nice instrument for indirectly targeting long-term interest rates by incentivizing banks to use funds for the purchase of government bonds. Okay, so looking back over the whole period of ECB's interest rate policy, one can say that the ECB's interest rates decisions were not always optimal. And you can do this by comparing the EONIA, which is, as you have seen, very directly targeted by the ECB, and you compare it with the federal funds rate, which is the policy rate of the US Central Bank. And here one can see some remarkable differences. I would say first is here in this period of the financial crisis, and the financial crisis became evident in summer 2007. So it was quite interesting at that time that until, I would say, June 2007, nobody really had the feeling that something dangerous is developing. So there was some kind of awareness that maybe with hedge funds there might be problems, but that such a huge thing of a financial crisis was already there. Nobody had an idea of it. It was quite interesting, and also personally made this experience that we were sitting in the German Council of Economic Experts in early July 2007, and we had the idea of let's write something on financial markets and something on hedge funds, because there was some feeling with the hedge funds there might be a problem. And then some of the members asked, but yes, we can write something in our report on these financial market developments, but what has it to do with Germany? And I said, well, good, that's true, but nevertheless, it might be quite interesting to report it. So we had no clue, and I think that was the same for all professional economists, that we were only 3 weeks away from the point where one could obviously see that we have problems with the financial system. And you could nicely see it that let's say summer 2007, the Fed immediately reduced its short-term interest rate. So they obviously saw what's going on, you could see it. The interesting thing is the ECB did nothing. You can see they kept interest rates stable, and they even in July 2008, they even increased interest rate. And this Lehman moment was in September 2008. So the ECB obviously had no idea at all what was going on. And that, I would say, is a huge mistake. And you can see if you compare it at the same time, the federal funds rate. So the ECB should have seen that the Fed is doing something. And you can see that the Fed was really in a kind of emergency mode, because it very rapidly reduced the short-term interest rate. ECB did nothing, and it took the ECB until the first week of October 2008 until it really started reducing its rates. So Lehman was September 15, 2008, and somewhere October 8 or 9, ECB realized, oh, we have to reduce our interest rates. So I would say that was a huge mistake of the ECB. And then the same thing happened in 2011. We were in the middle of the euro crisis, but there was some increase of inflation rate. And again, you can see the Fed did nothing. The Fed kept the interest rate very low at zero. The ECB had the idea that it's now a good idea to increase the short-term rate. And of course, this intensified the pressure on countries like Ireland or Portugal or Italy that already had problems. Instead of supporting the economy in such a difficult phase, the ECB increased interest rate. So that's really crazy. Well, it was all the pre-Draghi period. This was a period under Jean-Claude Trichet, the French ECB president, and one can also say this was also a period where the chief economist of the ECB was Jürgen Stark, a German, who obviously did not have any idea of what was going on. So that's why huge mistakes made by the ECB, and you can see it also if we already spoke about it. If you look at the bond holdings, again here we have the financial crisis, and you can see immediately the Federal Reserve and the Bank of England started to purchase government bonds to keep long-term rates low. ECB did nothing until 2015. So here, these are the bond holdings of the Bank of Japan. They are huge relative to GDP. So I think that was another major mistake. And we have seen that the long-term interest rates in the euro area were very high in 2010, 2011. And in this respect, fortunately, the situation today is completely different. Now the ECB is really doing whatever it takes, keeping interest rates low, and that's the way how we can go through this pandemic without having a euro crisis, because that's something which would be a disaster if we had now also a euro crisis. But by providing ample liquidity with this pandemic emergency program, with the huge size of bond purchases, the ECB has prevented so far that we get a euro crisis. And if you look at the data at 2008, 2009, 2010, the ECB obviously did the wrong things, which was really bad for countries like Spain or Greece, who's really suffered from the pressure on their economies and high unemployment and so on. So finally, coming back to the quote by Keynes at the beginning. So what you can do if you combine conventional and unconventional, you can control at the same time short-term and long-term interest rates. And this is very explicit in the so-called yield curve control that the Bank of Japan started in 2016. And you can see how they do it. So this is a decision from May 2021. And they say, okay, short-term interest rate, the bank will apply a negative interest rate of minus 0.1% to the policy rate balances in current accounts held by financial institutions at the bank. So this is a kind of deposit rate. So this is what the ECB also does. But then they make an explicit announcement on the long-term rate. They say the bank will purchase the necessary amount of Japanese government bonds, JGBs, without setting up a limit, so that the 10-year JGB yield will remain at around 0%. So a clear target for the long-term rate, and say, okay, we will buy as much of these government bonds as needed to reach this long-term interest rate target. I think that's a very interesting approach, especially if now, when now the economies worldwide are now becoming stronger, if you get out of this recession, and then if there is a need for central banks to increase their rates, if inflationary pressure comes up, and then many people fear if central banks increase the short-term rate, there will be an uncontrollable increase of the long-term rate. And of course, this can happen because there's a lot of speculative elements in the long-term rate because it's determined by expectations. And there would be a risk if you just increase the short-term rate and if you just leave the long-term rate to market forces. And this is something many people are afraid of, and that's why many people say that's why the central banks will not raise the short-term rate in a way which is required to prevent inflationary tendencies. But here, the model of the yield curve control shows, yes, you can increase the short-term rate, but at the same time, you can also try to control the increase of the long-term rate to prevent that you get excessive increase of the long-term rate, which of course would be a problem also for governments which have relatively high debt levels. And so I think this is a very interesting model. For the euro area, of course, the problem is we don't have euro area bonds, but I've already shown you this benchmark bond yield, which the ECB calculates. And so the ECB could just try to control this benchmark bond yield, which is kind of average bond yield for government bonds. So it would not directly control long-term interest rates, let's say for Italy or for Spain, but it would control this benchmark interest rate. And I think that's a very promising approach. Maybe just a word, what is the yield curve? The yield curve shows the yield for bonds for residual maturity. So this is a yield curve quite recent from the ECB. And here you have the yield of bonds. And here you have the residual maturity of bonds in years. So for instance, here you can see that the yield for a bond with a residual maturity of 15 years is a little bit above zero. So these are AAA rated bonds, so these are German bonds and French bonds, I would say. And so you can see for each maturity, the yield curve shows you the yield of a bond. And yeah, so that's a way to graphically show the yields for bonds depending on their maturities. And so the yield curve is always presents a situation on one day or on 1 month. And it's a very, very informative way to show this relation between yields and maturity. Okay, so far for today, are there any questions?
How's the Bank of Japan's yield curve control different from the Fed's operation twist?
Well, I think the Fed did not announce a numerical target for the long-term rate. I think that's, of course, all central banks that do unconventional monetary policy target somehow the long-term rate, but they do not announce a specific target value. I think that's the interesting thing with the yield curve control. In the United States, you can see that now the long-term rate already has come up quite a bit. And the Fed did nothing to prevent it. And so the Fed does not have announced so far any target for long-term rates.
And then the student asked, when yield curve control is implemented, how should people invest their savings when they want a safe asset when it does not make any sense anymore to buy government bonds?
Yes, but yield curve control does not necessarily mean that it's always negative or zero. Yeah, so it could also be, let's say, 1% short-term rate and 2% long-term rate. So there's, of course, Japan is a special case. And there the yields have been zero since decades, but also inflation is also not there in Japan. But you can apply yield curve control also, of course, in an environment with positive interest rates. And I think it's now quite interesting situation in the case of the United States, where the Fed will increase short-term rates and we will see positive short-term rates. I think that's also quite an experience for all of us, because we have seen zero interest rates for so many years. It's really interesting to see now whether short-term rates go up, whether long-term rates go up, but it remains to be seen.
What's your take on the Bank of Japan's equity purchases? Do you think that other central banks may follow suit?
That's also a good question, yeah. I did not mention this. The Bank of Japan is also actively purchasing equities on the stock market. And yeah, that's a difficult question, because when you purchase on the stock market, you also assume a certain responsibility for the developments on stock markets. and so far I think it was not necessary to do it. So because somehow you also take the risk out of stock markets, and so when the stock market plunged in spring 2020, so I thought it might be a good idea for central banks to purchase equity in order to prevent a kind of implosion of the equity market. But I must say I was too scared. And in retrospect, it was a better decision by the ECB and other central banks not to interfere with the stock market, because it stabilized itself. And so I think it's very, very problematic to interfere with the stock market, because then you're somehow liable for what's going on. And so I don't think it's a good idea. It was a good question. It was good to ask this, because this is a specific element in Japan that you don't see in the United States or the Euro area. Okay, any more questions?
So far, no more questions.
Okay, then thank you for listening, for attending. And so we are also now discussing whether it might be possible next week or maybe in 2 weeks to have a real lecture here in Würzburg. For those who are in Würzburg, of course, we would still then record it and also transmit it. But if it's possible technically, I think we would be really happy to see you, to meet you in person, and we will inform you how successful we'll be in this. But I think I would really love to have a real auditorium, to have real students, instead of all this Zoom and just looking into the camera and not seeing any faces. So let's see what we can do. Okay, I wish you a pleasant week, and enjoy the summer, enjoy the enjoy the old normal that we are now approaching. Okay, bye-bye. Thank you.